Okay. We're going to hop over to enrolling in your 401k plan. For those who are new in the 401k plan or haven't set up a username and password, you have the website with Empower Retirement on your screen. EmpowerMyRetirement.com is a landing page, and you'll see the dashboard view or the landing page there on your screen. In the right top corner, you'll see the sign-in button and register. If you do need to reset your password or username, you can use that login help link there. First-time users will hit register, and then you will have an account verification, which is the far right-hand side of the screen. And you have a couple options to either select I don't have a PIN, I have a PIN, or use a plan enrollment code. Empower Retirement will mail a piece of paper out to you that will have the PIN on a piece of paper. If you do lose that, nothing is lost. You'll have an option to use the I don't have a PIN, and you can put in that information and verify yourself in the system. Okay. We're going to hop over to a couple quick things on changes to the 401k plan that have impacted the 1/1 effective date. For those who are new employees, some basic plan details. You are eligible after 90 days of service. The company contributions will start after 90 days. And then you can also roll over the funds from another 401k or another IRA if you have outside assets after that period of time as well. All employees who have worked 90 days that don't do anything with the enrollment will automatically be enrolled in the 401k plan. So if you do nothing, you'll automatically be enrolled in the 401k plan, whether it's today, tomorrow, a month from now. Whenever you hit that eligibility point, you would be enrolled into the plan. Some changes. After 1/1, if you become eligible, the auto enrollment will actually click in at 6%. So if you do nothing, you become eligible after 1/1/2020, you would be starting at 6%. Currently, if you hit auto enrollment before that or have hit it previously, it was at 3% with a cap of 6. It's now going to start at 6 and cap at 10. But if you are still on that 3% auto enrollment and auto increase, you're still going to stay on that path, but the cap is not going to be at 6, it's going to change to 10. So if you are at 3% previously, you went to 4, you may be at 5 now, it's going to still keep climbing by 1% each year until it caps out at that 10. So if you think about it, it's an auto enrollment train. If you're on that train, you're going to still keep going on that path. If you hop off of it, you're no longer on that train. So you can make any adjustments at any time to your auto enrollment or that contribution number, and you would hop off of that train and basically do your own schedule. Okay? You can build into the system the automatic deferral increases, which I'll show you here in a little bit on a web demo, if you would like to do that. If you wish not to participate, you will need to go in and elect you change that contribution rate down to 0 in the Empower system. Company contributions will start when you're eligible. That rate is also in your contract. A quick reminder, please make sure to update all beneficiaries in the system. Make sure you have one in there as well. We'll show you how to get that information or access that information online here in just a minute. There are some fun changes that are going to be happening to the investment menu or the investment options that are in the plan. Those will take effect over the next couple weeks, and you'll see some notices that will come out in the next few weeks as well around those changes. What essentially happens is an old investment choice will get replaced with a new one. If you have money in the old, it'll automatically get transferred over to the new. You don't have to do anything. We're just replacing one and putting in a better fund in that replacement. Okay? I want to hop over to a brief website demo to show you a couple cool features on the Empower's website. We've got a login account right now. This is a dummy user, so it is nobody's information here at the City Light and Power offices. This is the landing page that you would get to once you first log into Empower system. At the top in the middle, you'll have a percentage of your goal. Ideally, we'd like to see everybody at 100% of their goal here, and that would mean that you're on track to replace your monthly income needs in retirement. You'll see here there are multiple categories, whether it's your savings, employer contributions, Social Security, any outside assets, if you've got other 401k accounts, savings accounts, And then the income gap would be what money you would potentially be short in retirement. You'll see as you change these slider bars below, if you want to edit your contributions or the retirement age, it will affect your overall score in real time. So if you're going to work later, that will mean that you're going to save more over those periods of time and not spend that as you're working. So you'll see as your percentage changes, the bigger the number, the better. 100% would be your 100%, or you would be replacing the income needs that you have. A couple contribution changes you can make is before tax. You can also adjust into Roth, and we'll talk about that here in a minute. But you'll see what you would need to save in order to get up to that 100%. And you can review those changes on the fly right here, and then also make those changes effective just by clicking this blue button and confirming that's the change that you would like to make. So in this example, that participant was saving 6. They're going to go and change their contribution to get back on track to, I believe, 18% in this example, work a little bit later, and then they have an income gap of just only $100 per month. So a much better picture from a retirement standpoint. Again, this may be a good snapshot of what you have, but unless you put in your other assets, it may not be a true picture of everything that you have. You can put in other assets on the tab here, listed other assets kind of below the middle section, and then you can add yes, I do, and then you can plug in those bank accounts, retirement accounts, and so on. There is a Social Security option if you would like to change it or not include it. You can adjust those model assumptions by putting in what's estimated, or if you have your Social Security benefit or you know it, you can change that as well. And you can also start it at different times, depending on what you would like to do. I'm going to go to, again, the home page, and I wanted to show you just a couple other quick features of the website. I'm going to hit Account and then hit Overview. I feel that this is probably the best dashboard or best view for navigating the website. They have all of the items listed on that left-hand column. You can quickly toggle and get between most of the information, if not all of it. Viewing rate of return, your balance, just quickly hopping into the balance one. You'll see how your balance is broken out by money types, whether it's your contributions in before tax, after tax, which would be Roth, so there would be another line there, and then the employer contributions. The third tab, Balance Over Time, I personally feel is a great snapshot of seeing how your portfolio does in the market highs and the lows. So click on that. You can see how your account has grown or decreased through market cycles from the time that you have started. Rates of return, quick filters, you can pick certain dates, but you can also pick a certain date range and find out what your rate of return is for that period of time if you would like. Beneficiaries, we talked on the last slide. It's on that 6th one down, 7th one down. Please make sure you do have a beneficiary listed in here and make sure they are up to date. Beneficiaries will supersede a will or a trust. So please make sure you are updating this as life changes. In the event that you do need to change it, you have options here, and you can change it in real time. You can change it at any time as well. So nothing is set in stone. Contribution amounts, traditional versus Roth, or even beneficiaries. You can go in here and change it 24/7.
So anyone we can put, even though that person is not reside in this country, but it's outside of the country, is that okay?
So the question is can we put somebody as a beneficiary that may or may not be in this country or a U.S. resident? I would have to verify that, but they do require a Social Security number, so I would have to verify that.
Okay.
But you will need all of these pieces of information. The prior session asked if a minor or somebody under age 18 can be a beneficiary, and the answer is yes. Just make sure you put in the date of birth and Social Security number in there. I'm going to hop down to the investments. I just clicked View and Manage My Investments. You'll see here where your current money is invested based off of the balance on the right-hand column, and then where your new contributions or the new payroll contributions are going to be going in. I would recommend that you have those numbers match. So in this example, they don't match, and you would want to go and change your investments and rebalance them to match that current balance. So your future allocations you would want to change to mirror what you have in the current balance or vice versa. I recommend that that scenario be the same with both your old money, technically, and what your new money would be going in as well. Changing investments is easy. You just click Change Investments, rebalance your current balance. This box here where it says I direct my future investments this way as well, you're going to change your old money and your new money all in one process. And then you hit Continue, choose individual funds, or Help Me Do It, and you can pick between which investments you would like, either using the slider bars or typing in the amounts over on the right-hand side. Once you hit Submit, you'll get a confirmation page, and it would take a day, depending on if you're doing it on a weekend. It would happen the next business day or the market open. Okay. I'm going to hop back to the dashboard here. I wanted to briefly cover over the traditional versus Roth contribution. Before tax is paying your taxes when you would withdraw the money in retirement. After tax or Roth, you would be paying the taxes today. So depending on what you feel the tax rates are now and what your perceived tax rates would be in the future, one could argue you pay less now or pay less in the future. Most people that are in a lower tax bracket or younger will do Roth. People who are looking to reduce their taxable income and take that tax break now will do the before tax, pre-tax option. You can change it at any time. So whatever you decide today, tomorrow, next year, you can adjust it over time as well. There's not necessarily a crystal ball answer of what may be right or wrong, because we do not know what tax rates are going to be in 10, 20, 30 years from now. It is somewhat of a best guess. Okay. I wanted to pause to see if there's any questions so far on the information that we've covered. For those who are on the line or dialed in, are there any questions at all? Okay. So we're going to hop back over to a little bit information on savings, importance of savings. For those who are younger, this is a very important slide, so please pay attention. We actually had a request from an employee here that wanted to share this information, this particular slide, with their 18-year-old son. So what's important about this is the power of saving early and often, and how that can compound over time and grow to a very large number. So investor A started saving when they were 23, $5,500 per year. They invested roughly $50,000 over that 9-year period of time, and then stopped saving at age 32 and did not save another penny after that. That account balance, annual increase of roughly 7% return, grew to almost $1 million. So $50,000 over a 30-year period of time grew to $1 million. Investor B did the opposite. They did not save early. They started at 32. They saved almost $180,000 or $190,000, and that account grew to just below $900,000, saving 4 times the amount of money and still having and ending up with less than investor A. Investor C would be the ideal candidate. You started early, you saved often, and you stayed the course through your working career. And that would equate to roughly $2 million in this example. So starting early is really the leave behind and the takeaway from this. If you've got colleagues, children, friends, you yourself, start early. Procrastinating on saving is going to delay your retirement, potentially. And we've got a slide for that, unfortunately, which is coming up here. So retirement savings checkpoints. The way this slide will work is you'll find your income or your household income and line it up with your current age. You can use your particular income or your total household income between you and your spouse, and you would line it up and see what the total would be. What this is saying is this is the amount of money that you should have saved up to see if you're on track for retirement or replacing that income in retirement. In this example, we're going to just pick the 40-year-old individual, and they make $50,000. There's 1.7, and that would equate to roughly $85,000. So a 40-year-old making $50,000 should have had roughly $85,000 saved up, and then continue to save roughly 5% of their earnings in all future working years to stay on track. Another important slide that we would like to share with you is the annual savings needed if you started today with 0. So if you're starting out trying to catch up for lost time, this would be the savings rate that you need to be at to make up for that lost time in order to hit those retirement goals. You would use, again, those cross points, find your income or household income, line it up with your age, and then that would be a good starting point. The national average for participants saving in the 401k is 8%. So if you're thinking about starting at maybe 6 or you're at 4 or 5 right now, consider bumping that up to the national average or increasing it by 1% and using that 1% increase every year to get up to that higher rate. As you can see, the older you are, the more you have to save to catch up. So procrastinating on that does impact your overall retirement savings bucket at the end. Wanted to hop over to a little bit more market news and market information. This is a chart of the S&P 500 index. The S&P 500 is a combination of roughly 500 companies in the US, and those 500 companies make up this index. This index chart goes back to 1996, when the S&P value was roughly 740 points. It grew to double, roughly, almost 1,527 points. The tech bubble crash in 2000 brought it back down to almost where we saw it in 96, and then back up in 2007, and then the 08 crash and the Great Recession. And then the period that we've seen from 2008 all the way to the present day this week. This chart actually goes through Tuesday of this week. The S&P was up slightly yesterday. Last time I looked after lunch today, it was roughly flat. So, 3,092 is probably a good barometer of where the S&P 500 index is right now. The reason why we wanted to pull this up is just to give you some perspective of the stock market as an index or leading indicator of the stock market over a very long period of time, 20 plus years in this example. The markets do go up and down. You'll see some of the worst markets that we've seen in 2001, also in 2008, with a 50% or greater decrease in the market. If we were to see a decrease of this same size, if it started at the top, and I'm looking at the top right corner, if it started at that 3,000 number and it decreased by 50%, take half of that off, you would be at the levels that they were in the top of 2000 and 2007 at that 1,500 mark. So not losing everything back down to 2002 values or 2009 values, but a 50% correction or a recession would indicate roughly about a 1,500 value. So we're going to hop over to the impact of being out of the market. This will show the returns of the S&P 500 in that exact chart, performance of $10,000 invested in 1999, going through to the end of the year in 2018. That return will show that you see on that top left bar is the 29,000 amount. So that $10,000 grew to $29,000, almost $30,000 over that 20-year period of time, with an average return of almost 6%. If you missed 10 of the best days, you would cut your return almost in half, if not greater, down to roughly $15,000 or 2.1%. That's just missing 10 of the best days out of 5,000 trading days over 20 years. 6 of the 10 best days occurred within 2 weeks of the 10 worst days. And you'll see on that middle box, the best day in 2015 on August 26th occurred within 2 days of the worst day on August 24th. Plan to stay invested is really the leave behind and the takeaway of this slide. We want folks to pay attention to their investments, but also be mindful that over time, the markets will go up and down, and we want to make sure that you are being disciplined and investing appropriately over the course of your investment career, through retirement, but also as you're working. We're going to hop over to the yield curve inversion. Actually, before I do that, is there any questions at all about the markets, about what we just showed through the impacts of being out of the markets, returns, the S&P 500 chart as well. Are there any questions on the phone? All right. So we're going to hop over this slide. I'm going to preference is not intended to scare you. I promise. It's really not. It's to provide information about what we see as a leading economic indicator of possible recession. This yield curve inversion, you may have heard in the news maybe a month ago or 2 months ago that the yield curve inverted for a short period of time. This chart represents the 10-year yield minus the 2-year, and it's plotted on that axis. The 0 percentile line would indicate a yield curve was inverted, and there are roughly 9 points over the last 80 years in which the yield curve has inverted. 7 of the 9 have led to a recession. The recession bars are those gray bars that go up and down from the top to the bottom. And the length of the bars is just the same, but the width is the time frame and how long that recession lasted. So you'll see in 2001 and 2007-8 is the most recent one. We are very close, and we have crossed that line ever so slightly. One day, we still are floating above that right now. So it is not inverted like we would see below that 0% line. The average time from a yield curve inversion to a recession on that bottom right corner is 14 months. Some of them are shorter. Back to 1973, we could argue that the markets are vastly different than what they are 50 years ago. But just to be mindful that if you were just a betting person, if you see all these gray bars over a 60-year period of time, we're bound to have something come up. This is an indicator. Again, we want to be mindful that you are investing appropriately. And going back to this slide, if you're buying at all points of the market every 2 weeks, you're going to buy as it goes up, you're going to buy as it goes down, and so on. And over the course of time, over a long period of time, you're going to fare very, very fine. Even if you bought in the highs of 2000 and the highs of 2007, you still have had roughly 100% return from 1500 up to 3000, even if you bought at those points. But if we were to average all of those points on this plot here over the course of that roughly 20-year period of time, it'd be somewhere around that 1,000-point line or 1,200-point line, and you would have roughly a 200% return over that long period of time. So your money would essentially double, plus your new contributions going in there. So I wanted to hop over to the model asset allocation guide. This is our advice to you to help with your investment selection in the 401k plan. All of your investment choices are listed on that left-hand column. You have the asset class that they represent in the second column, or the sector. The ticker symbol is the third one. If you care to do more research, feel free to Google those 5 letters. That's the easiest way to do it. Also online in the investment section, and I'm going to hop over to that just so you can see it. If you hit My Account and click Investments, you'll see where they'll have the fund choices that you're invested in, and you can click those. But if you hit the investment line up on the left-hand column, you'll see where there's options to view performance, prospectuses, and also investment overview. So this will be real-time with your investment options as you log in. Going back to this sheet, this is updated every quarter. The newest one would come out in January, roughly the end of January. These columns are broken out into different risk tolerances for those who want to be hands-on. So that larger rectangle at the top is going to be for those hands-on investors that would like some advice and want to pick individual funds in this option. There are 5 risk tolerances from conservative all the way to aggressive. For educational purposes, individuals that would be in their 20s and 30s would be appropriately invested in the aggressive column. 40s and 50s would be in the moderate aggressive, and then 60s would be in that moderate column. Folks that are looking for just preservation or looking to preserve what they have, that moderate conservative or conservative portfolio would be appropriate for those who are in retirement or looking more for a conservative investment. Individuals that would like to be hands-off, that T. Rowe Price target date series would be appropriate for you based off of your age. And you would find out what year it would be when you reach age 65. And that's going to put you into one of the target date ranges, which is the second column. So if you're going to be 65 in 2040, that 2040 fund would be most appropriate for you based off your age and how long you would be working till. They start out aggressive, so the bigger the year is intended for the younger person, and they would be aggressive when you start, roughly 90% for those who are in their 20s and 30s. And then every 5 years, they de-risk automatically for you. So it's good for you today, but in 5 years and 10 years, it's going to be less aggressive over time. It follows a glide path. So you can also change your investments at any time. What you decide today, what you've decided in the past, you can change it at any time. There's no cost of going in and out of any fund at all. There is a cash account or a key guaranteed account, which is the very, very bottom option. So if you are looking for more of a safe haven or a cash account, that bottom bucket, which is a key guaranteed portfolio, would be a cash account. It has a fixed rate of return of just over 1%. We want to make sure people are investing appropriately in their 401ks. So if you're in your 20s and 30s, we don't want you sitting in the cash account because you need that performance. You need that compounding interest like that investor A had, 7% return year after year. 1%, if you're sitting in that key guaranteed account, isn't going to be enough for you to have that account balance to grow up to that, say, $1 million example. Again, these are two options. This is a guide for you to use if you would like. You can use this or you don't have to. You can pick whatever else you would like out of these choices and find out whatever percentage you would care for in each of those options. Hopping over to a couple last things is the rollover IRAs or past 401ks. If you've got an old account balance at an old provider, you're free to roll those monies over to the new plan or the CLP plan if you would like. You can leave it there in most cases. If you would care to consolidate, that is something that Empower can help you do. Their 1-800 number is listed there. That 1-800 number can be used for password resets, any questions with Empower. Our contact information is on the next slide, and you're free to reach out to us as well. A quick mention on that rollover team. In most cases, they can do everything over the phone for you on that transfer or that roll over or roll in, but they also can help you with rolling out the money as well. So if you are no longer working at City Light and Power and you'd like to move your money out of the plan, you can call that 1-800 number and they can help you with a distribution over to either your new plan, an IRA, and so on. But their team, just as a quick mention, if you're working with an old provider, maybe say like an older life insurance type company with the rollovers, they may have you fill out a paper form. So their intention is to have everything done over the phone and electronically, but you may have an occurrence where you have to fill out a form from your old provider to get them to mail you a check. So just be mindful of that. There is an email team that they will get back to you very promptly as well. Their hours are fairly long as well too, so please be mindful of that. Last and finally, both myself and Mark are available to each one of you. If you would like to reach out to us with individual questions, want help, you have any questions on anything else, feel free to reach out to us. That's what we're here for. We welcome any call, any email. We've talked to many of you. We would welcome anybody else that would like to reach out to us. Okay? Are there any questions here in the room? Any questions or comments that you would like to ask on the phone?
Is there any monthly fee?
So there's no monthly fee to enroll. The fees, the question is what are the fees? The fees, there is an investment fee and there's a provider fee. So Empower Retirement charges a very small amount, and then the investments, there's a very small amount too. And those fees are broken out under those prospectuses that I would, you would refer to. So if you were to click, each mutual fund has its own expense ratio. So you can go in here and download these prospectuses and view those expense ratios. And you'll see performance. That will actually probably show you too. This is just a dummy account, but you can see those expense ratios on that performance section as well too. And this would normally load a PDF that you could download.
You don't get any bills or anything like that?
No.
It's taken out of the money you have in the account?
Yes.
Mm-hmm.
Okay. And is there anybody on the line that has any questions? Great, quiet group this afternoon. Well, great. Well, thank you again for everybody's time today. As always, please reach out to us if you have any questions, if there's anything that you need to reach out to Empower on. Again, there are 1-800 numbers listed here. I know Kim has mentioned that she's going to be sending out this presentation along with other plan information like the asset allocation guide, the newsletter, and then some of those other notices around the fund changes and the auto enrollment changes as well too. So be on the lookout the next few weeks, next couple of days of that information coming out to you. Awesome. Thank you all.
Could you find out about that beneficiary?